no blue is not enough.
Hello everybody, and welcome to the third part of my series, How to Trade for Beginners. And a couple things I want to get out of the way first. The reason there's such a big delay between the second video and this one is I'm getting over a cold, and I want this stuff to be able to be shared for as many years as there are to come, because it's free, right? It's always going to be free, and that's how the strat has always been. So I want this to be quality. And second, that being said, since the strat hasn't changed since Rob invented it over a couple decades ago, this is going to be very similar to Rob's previous explanation. And the reason it is because he made it, he knew it the best. And if that's how he wants to explain it, then who am I to come in and say we should do it a different way? So all these materials are going to be free. They will be linked in the description. And if you want to see the original series, it is linked in those PDFs or in the description of this video. So now that that's out of the way, let's talk about Rob and then get into the strat. So before we start, who is Rob? Rob is a previous floor trader from the Chicago Stock Exchange, and he was there for a couple decades. And he developed a strat because through his similar studies and failings with traditional technical analysis, he realized that the things in the book and the things that people were trying to say quantified the market actually didn't. It was all subjective. Like patterns, completely subjective. Support and resistance, completely subjective, etc. So he knew there was an issue, and he set out to solve it. And the way he did that was using an approach of quantitative analysis, because what we're truly looking at is data. And therefore, he decided to break down price action by time frame continuity, actionable signals, and price discovery broadening formations. And that last one's really important, because if you read any book about trading or the markets that talks about a broadening formation, they will say it is extremely rare, but it is actually the opposite. It is the only pattern that can happen. So we're going to set out to show you guys how that works. And now that you know a little bit about Rob, let's get into learning about his life's work, the strat. So in this video, we will be covering candlestick formations, inside bars, and the Rev Strat. And then in the next video, we will do the flip, combinations, the measure to move, the importance of time, and then a summary and live charts. And when we get to the live charts, once you guys understand this, you're going to be really excited, because we can trade anything. And once you understand how these signals work, we can tell you what's going on right now, and you can start trading right away. So let's get into it. Let's get you guys there. So first, candlestick formations. These allow us to expect price to move. And this is because actionable signals, another word for these candlestick formations, quantify specific technical conditions. More specifically, they show us important equilibriums that must, at the very least, attempt to break, as well as showing us when we can identify market participants caught on the wrong side of price movement. So when we're saying this, what we mean is, for example, Tesla. Why did it go up so fast and so high? Well, if you paid attention, it was a highly shorted stock, meaning there was people caught on the wrong side of the price movement, because if you're heavily short and it's going up, you have to buy the stock to close it, which pushes it even higher. And the same thing happens on the downside. So these actionable signals allow us to quantify that condition. So we don't need any external data. We can see it in the charts, and it's very beautiful once you understand. So let's talk about these actionable signals. The first one is the regular hammer. This forms after a previous lower trend series, or just multiple bars to the downside, to potentially signal a reversal off the lows. The open and close are in the top 33% of that candle's range. So you'll notice these open and close levels, the opens here, the closes here, occur in the top 33% of this candle's range. This signal goes in force above the high of the hammer candlestick. We are expecting this to work for the following reasons. Ideally, the shadow or wick of the candle, which is this part right here, represents an exhaustion of long side sellers combined with poorly timed new short positions. And what that means is long side sellers is just anyone who bought this stock before. It's now going lower. So if you bought it at this price level, let's say a couple weeks ago, and it comes back and you're now holding a losing position, you turn into a long side seller. You're someone who bought it and is now selling to close because it's a loser. And then the poorly timed short positions. If you watch the second video, remember, the only way this candle can go red is if the sellers are more aggressive. So if it's going lower, there's new short positions being opened. Or at the very least, there are long side sellers getting forced out of long positions. And although the hammer is an actionable signal, it's not a universal truth. And this is because we cannot know for sure why the hammer formed. Meaning, we don't know for sure if people actually got shorts in here. It could have just been people stopping out. And we also don't know for sure if this is just people stopping out or not. It could just be people shorting it. So we don't know. But we do know the reason that the hammer is an actionable signal is because should the conditions of ill-timed shorts and seller exhaustion be true, the probability that the hammer will send prices higher is heightened. We also have the momentum hammer, or also called the Momo hammer. This forms near the highs of a previous strong uptrend. This signal goes in force above the high of the momentum hammer. So it must form the hammer after a strong uptrend. It must close, and it must trade above the high of that hammer to go in force. The reason we expect this pattern to work is on the rationale that because it is in a strong uptrend, the shadow or wick of the hammer candle only represents a profit-taking pullback. Anyone that was long before, just taking some profit, combined with ill-timed short positions. So if you weren't long and you see prices going down, you get in there to try and short it, and then it launches all the way back up, you're going to have to go and close that short, which will push prices even higher. And since it's a strong uptrend, like we talked about in the second video of this series, the fact that it's going up tells us the buyers are more aggressive. So if you're stuck short and the buyers are more aggressive, you're going to get killed, which is exactly what we see occur here. We then have the shooting star, or the shooter. And this is going to be pretty much just the opposite. So this forms after a previous uptrend to potentially signal a reversal off the highs. The open and close are in the lower 33% of the candle's range. This signal becomes in force below the low of the shooting star candle. So it must form, it must close, and it must trigger to go in force below this low. And the reason we expect this to work, ideally, because the shadow or wick represents an exhaustion of short side buyers, meaning anyone who's still short this thing and had to buy to close, they get exhausted. They're all out of their short positions. And that gets combined with ill-timed new long positions because it's going up. We know there's people trying to buy this thing. So thus, when we take out the low, putting it in force, we expect ill-timed long side traders to be forced to sell, sending it back lower. And although the shooting star is an actionable signal, it is not a universal truth. This is because we cannot know for sure why the shooting star formed. The reason the shooting star, or the shooter, is an actionable signal is because should the conditions of ill-timed longs and buyer exhaustion be true, the probability is high that the shooting star should work. Then we also have the momentum shooting star, or the Momo shooter. Forms on the lows of a previous strong downtrend. And this signal goes in force below the low of the shooting star candlestick. So you'll see it forms after a strong trend lower. We get the Momo shooter, and then it goes in force below the low of that candle. And we expect this pattern to work on the rationale that because it is in a strong trend, the shadow or wick of the shooting star candle only represents a short covering pullback combined with new ill-timed long positions. And once again, this is not a universal truth. Yet, when the conditions we expect are present, the probabilities are heightened. We then have kicking patterns. This is the bullish kicking pattern. And this occurs when a red bar is countered by a green bar that gaps above the red bar's entire range. So you'll see the big red and then we gap above it. What does that tell us? Well, it tells us the signal is in force so long as price is above the opening price of the second candle. So anytime above this open, it is in force, bullish kicking pattern to the upside. We can expect this setup to work on the rationale that the long side was decimated during the red candle, and short sellers could stay short as the bar went out on the lows of the range. So if you shorted in this day, you're probably swinging that because there was no reason to get out. If you shorted here, why would you exit here? Maybe it keeps going. Then you get the gap, and that causes all short sellers during the red candle to flip to a loss immediately. And ideally, it combines with new longs entering as prices are now trading higher. So this in and of itself is a reversal, right? So since prices are trading higher, anytime this is green, we know the buyers are more aggressive. And we know we have trap short participants. So that's a recipe for a nice big move like Tesla, right? This is one of my favorite earnings seasons patterns. And I've been tweeting out these setups for years. They're amazing. And once we get into earnings season for Q4, we'll be trading a lot of these. Up or down, it depends where we go. We'll figure that out in the future though. So we also have the bearish kicking pattern. This occurs when a green bar is countered by a red bar that gaps below the green bar's range. The signal is in force so long as the price is below the opening of the second candle or of the new candle here. And we can expect the setup to work on the rationale that the short side was decimated during the green candle. And long buyers could stay long as the bar went out on the high. And right here, this is actually overstock. And this was from last week. The gap causes all long buyers during the candle to flip to a loss immediately. And it ideally combines with new shorts re-entering as the price is now falling. Same thing, just on the opposite side for the bearish kicking pattern. So actionable signals, just to summarize. These are why we can expect price to move. And if you've been listening, it's pretty logical, right? And although we use hammers and shooters as actionable signals, they are not universal truths. This is because we do not know exactly why they formed. We can make informed decisions or assumptions, but we don't know for sure. Inside bars and Rev Strats are universal truths as they formed equilibriums or countered them, which cannot be disputed as the bar had failed to break a previous higher low. So, what is an inside bar? Let's talk about it. When we're looking to trade inside bars, we have to identify, are we trading a retracement or momentum? Because they are different. And what is an inside bar? It is defined as any bar whose range is equal to or less than the previous bar's range. The first inside bar setup that we're going to talk about is the bullish inside bar breakout, also known as inside and up. And this setup goes in force as soon as the price trades above the inside bar. And this is a universal truth, as it cannot be disputed that the equilibrium has been formed and a breakout of that equilibrium is being attempted. So the importance of these universal truths is when people are talking about consolidation breakouts, they're talking about pennants. But since those are completely subjective, you actually don't know if the equilibrium is breaking or not. Since we know about the inside bar, and since it's a universal truth, we know for a fact the equilibrium right then and there is breaking. If you're on a lower time frame thinking that we're doing a breakout of a pennant, you have no clue what's going on. So this is extremely important. But you'll notice we have the inside and break to the upside. The bearish inside bar breakout, also known as inside and down. This setup goes in force as soon as the price trades below the low of the inside bar. So a penny below this low and it is in force. This is a universal truth, as it cannot be disputed that the equilibrium has been formed and a breakout of that equilibrium is being attempted. So we mentioned retracement or momentum. This is where we're going to tell you what that is. So if the bar previous to an actionable signal, in this case the inside bar, is green. So if the bar previous to the inside bar is green and the actionable signal is in the upper 50% of that bar, a break to the upside is considered to be momentum, as it will be breaking into new recent highs. So if you have a big move higher an inside bar, and another break higher, that is momentum. If the bar previous to the actionable signal is red and the actionable signal break is to the upside, it is considered a retracement as the price had just recently dropped. Meaning if we trade lower, go inside and up, that would be considered retracement. It's important to remember that these conditions are subject to the conditions of the other timeframes outside of the stated inside bar setup, which will be covered when we get to timeframe continuity principle. So you'll see here, this inside bar and up setup, that would be considered what? Retracement, because this bar was red. Now, if we're on a higher time frame and we see the move higher, and then all of these bars would be considered an inside bar. So like, let's say these two candles get mushed together, that's your move higher. These two get mushed together, that's your inside bar. And then it goes inside and up right here. That, if we're looking at a higher time frame, that would actually be considered momentum, because this is all in the upper 50% of this range. But we'll talk about mushing candles together more in the future. Now, in this case, this is where we avoid the inside bar setup because we expect a new broadening formation series to begin as the price consolidates within the mother bar. So when this goes inside and breaks lower, we are nowhere near taking out the low of the mother bar, which is this bar here. So we don't short that. We don't want to play that. The reason being is because when you go inside, you start a new broadening formation series. And you'll see here, they actually make a slightly higher high to this high here and a lower low to this low here. That's a broadening formation. And then you go and create an actionable signal, and that breaks the high of the mother bar. And the reason we would want to take this one is because if the actionable signal is close to taking out the mother bar, we can take the trade on the belief that the signal will take price beyond the mother bar. So in this example, the inside bar to the upside that breaks the high of the mother bar, we would not want to take the break to the downside because it is nowhere near breaking the downside of it, like we said. The danger of trading something that is still forming an inside bar. Much like the multiple inside bar condition, this condition is something few traders realize, but it is extremely, extremely important to know. We want to know if anything we are trading is still inside a mother bar on any time frame, because it is considered to be consolidating until it can make a higher high or lower low. This condition is what causes price to be choppy. So if you've ever heard someone say, didn't do well today, it's choppy. This is why. So you're going to see the inside bar, we see it forming on the weekly time frame because it has failed to make a higher high or a lower low. Therefore, it is consolidating. And that causes the hourly time frame to be choppy. The beginning of the week starts, I believe, right here. They trade higher, then they trade lower, then they trade higher, then they trade lower, then they trade even higher, then they trade all the way back down lower. Then they trade actually higher again right here, and then lower again, and then higher again. So there's no trend because you're technically consolidating. And like we said, when you are inside on a higher time frame, you start over the broadening formation series. So you'll notice we make the higher high to this high here, and then we make the lower low to this low here. And then the next week opened and we actually made the higher high again. So very cool. You can see the broadening formation form because of this condition on the higher time frame. And during this condition, we expect Rev Strats to form. The Rev Strat. The reversal strategy, or the Rev Strat, is a reversal of the inside bar setup. This setup will occur either in the bar following an inside bar or a 2-bar setup following an inside bar. So you'll either get 1 bar to trade off of, or you'll get 2. And we can expect this setup to work because an equilibrium breakout was attempted and is failing. This means that one side has attempted the breakout and has been met with a stronger force in the opposite direction. This is a universal truth, as an equilibrium break has been reversed, which cannot be disputed. And little side note, if you've traded the box setup, which we have on my YouTube channel specifically, that's what this is. This is the box setup, but this is a quantifiable way of identifying it. So you can scan for this. The bullish 2-bar Rev Strat. A bullish Rev Strat occurs when a hammer forms after an inside bar and price confirms the setup by moving above the hammer. So you'll see we go inside. Then we form the hammer after failing one side, meaning they tried to sell it down and they were met with a stronger force to the upside. And then this hammer is in force as long as this candle is above this high and still open. And we expect this to work not only because we can identify the equilibrium reversal, meaning this is hammer right here, that is a reversal of the equilibrium break, but also because of mechanics of ill-timed shorts placing their stop at well-known pivots. So when this breaks lower, if you're shorting this stock, your high or your stop is either going to go here or above the high here. So when we trigger this, you are forced to buy. In the next example, we'll mark the known pivots in yellow. And the reason they are well known is because during consolidation, highs and lows are being watched by any and all traders. Oftentimes, you'll see traders put their stops at those well-known highs and lows. Those well-known highs and lows are the pivot targets we look to take out. And during periods of full time frame continuity, which will be discussed in the next video, there is no reason to believe that this setup will not work. Some people only trade the Rev Strat because of that reason. So the bearish 2-bar Rev Strat, you can see the pivots are marked in yellow. So we have the trigger and then multiple targets. And this is a monthly time frame, so it's like you got all month to trade this stuff. A bearish Rev Strat occurs when a shooting star forms after an inside bar and price confirms the setup by moving below the shooting star. So it forms, it closes, and then the second it's below that, and red here, that is in force. And therefore, any ill-timed longs, anyone that bought into this thinking it's going higher, is likely to have stops at these well-known pivots. Now we have the 1-bar Rev Strats. These are a little bit trickier to trade. This was KR last week on Friday. And it is 9/10/2023 if you want to see that. This is a daily time frame, I believe. The setup occurs when an inside bar breaks to the downside, then reverses higher to take out the high of the inside bar. We can expect this setup to work as an equilibrium has been reversed, which cannot be disputed, as well as expecting stops on the top of well-known pivots of the highs and of the inside bar and mother bar. So you're going to see they break it to the downside with a gap. They go green and take out this high here. That is the trigger of the 1-bar Rev Strat. And then they take this out and they continue because the buyers are more aggressive. Then we have the bearish 1-bar Rev Strat. This is a 2-week chart on Boeing. This setup occurs when an inside bar breaks to the upside, then reverses lower to take out the lows of the inside bar. In this example, you'll notice even if it's only 1 penny higher than the previous high, that is still a potential Rev Strat. People try to ignore the wicks. If you're talking about smart money traders like ICT people, they ignore the wicks all the time. But it's important because that penny above tells you the potential Rev Strat. When this is up and red, if it hits that, that's the trigger, and they're going to try and take this out because of your well-known pivots, right? So a 1-bar Rev Strat can become a 2-bar Rev Strat. And this occurs when a 1-bar Rev Strat closes and forms a hammer or shooting star candle. And we'll cover this during the broad information discussion. But because an actionable signal has formed following an inside bar, this is still a countering of the known equilibrium. The only way this can occur is when the price equilibrium breaks 1-bar Rev Strats and then retakes the original breakout side of the inside bar. In this case, the new Rev Strat triggers above the hammer that follows the inside bar. And I know that's a lot, but here it goes. I don't have the example in here. I will get it in here. I just forgot to get one for you. But I have one on the top of my mind. So we'll go to the weekly time frame and REGN. And this is an example of a 1-bar Rev Strat. So you'll notice the actionable signal. You'll notice we did take out both sides of the equilibrium, but they took out both sides and then rallied all the way back. So if we go here, you'll see they made a new high, made the new low, came all the way back, and that sets up the 2-bar Rev Strat. So when we're looking at this, it retakes the original breakout side. So it takes the high first, breaks out there first, fails, and then retakes it. So on the weekly basis, if our actionable hammer goes in force right here, that is a signal to the upside, and you will have all week to trade that. So that is your example, and this is going to end off the first part of this series where we're going through the PDFs and learning the basics. So if you like this, please drop a like. If you enjoyed, comment too. That'll help on the algorithm, and I'm trying to reach as many people as possible. So hopefully you guys enjoyed, and I will see you guys in the next video.
And I'll know